Okay, now reading 29 on income taxes. Learning outcomes. The candidate should be able to describe the differences between accounting profit and taxable income and define key terms including deferred tax assets, deferred tax liabilities, valuation allowance, tax payables, and income tax expenses. Explain how deferred tax liabilities and assets are created and the factors that determine how a company's deferred tax liabilities and assets should be treated for the purposes of financial analysis. Calculate the tax base of a company's assets and liabilities. Calculate income tax expense, income tax payables, deferred tax assets, and deferred tax liabilities, and calculate and interpret the adjustments to the financial statements related to the change in the income tax rate. Evaluate effects of tax rate changes on the company's financial statement and ratios. Distinguish between temporary and permanent differences in pre-tax accounting income and taxable income. Describe the valuation allowance for deferred tax assets when it is required and what effects it has on financial statements. Explain recognition and measurements of current and deferred tax items. Analyze disclosures relating to deferred tax items and the effective tax rate reconciliation, and explain how information included in these disclosures affect the company's financial statements and financial ratios. Identify the key provisions of the differences between income tax accounting under International Financial Reporting Standards (IFRS) and U.S. generally accepted accounting practices or principles (U.S. GAAP). Introduction for those companies reporting under IFRS. IAS 12 income tax covers accounting for a company's income tax and reporting of deferred taxes. For these companies reporting under United States generally accepted accounting principles, US GAAP, FASB, ASC topics 1740 and 40. Income taxes is a primary source of the information for accounting for income taxes. Although IFRS and US GAAP follows similar conventions on many income tax issues, there are some key differences that will be discussed in this reading. Differences between how and when transactions are recognized for financial reporting purposes relative to tax reporting can give rise to differences in tax expense and related tax assets and liabilities. To reconcile these differences, companies that report under either IFRS or US GAAP creates a provision on the balance sheet called deferred tax assets or deferred tax liabilities, depending on the nature of the situation. Deferred tax assets or liabilities usually arise when accounting standards and tax authorities recognize the timing of revenues and expenses as deferred times. Because timing differences such as these will eventually reverse over time, they are called temporary differences. Deferred tax assets represent taxes that have been recognized for tax reporting purposes, but have not yet been recognized on the income statement prepared for financial reporting purposes. Deferred tax liabilities represent tax expense that has been appeared on the income statement for financial reporting purposes, but has not yet been payable under tax regulations. This reading provides a primer of the basics of income tax accounting and reporting. The reading is organized as follows. Section 2 describes the differences between taxable income and accounting profit. Section 3 explains the determination of tax base, which relates to the valuation of assets and liabilities for tax purposes. Section 4 discusses several types of timing differences between the recognition of taxable and accounting profit. Section 5 examines unusual tax losses and tax credits. Section 6 describes the recognition and measurement of current and deferred tax. Section 7 discusses the disclosure of presentation of income tax information on companies' financial statements and illustrates its practical implication for financial assets analysis. Section 8 provides an overview of the similarities and differences for income tax reporting between IFRS and US GAAP. A summary of the key points and practice problems in the CFA Institute multiple choice format concludes this reading. Let me drink my water. I'm just drinking plain water today. Chilled, of course. Differences between accounting profit and taxable income. A company's accounting profit is reported on its income statement in accordance to the prevailing accounting standards. Accounting profit does not include a provision for income tax expense. A company's taxable income is the portion of its income that is subject to income taxes under the tax laws of its jurisdiction. Because of different guidelines for how income is reported on a company's financial statement and how it is measured for income tax purposes, accounting profit and taxable income may differ. A company's taxable income is the basis for its income tax payables, liability, or recoverables, which is calculated on the basis of a company's tax rate and appears on its balance sheet. A company's tax expense or tax benefit, in the case of a recovery, appears on its income statement. And its aggregate of its income tax payables and any changes in deferred tax assets and liabilities. When a company's taxable income is greater than its accounting profit, then its income tax payables will be higher than what would have been otherwise been in a case had income taxes been determined based on accounting profit. Deferred tax assets, which appears on a balance sheet, arises when the excess amount is paid for income tax, and the companies expect to recover the differences during the course of future operations. Actual income taxes payables will thus exceed the financial accounting income tax expense related to deferred tax assets and valuation allowance, which is which is a reverse reserve created against deferred tax assets. The valuation allowance is based on the likelihood of realizing the deferred tax asset in future accounting periods. Deferred tax liabilities, which also appear on the balance sheet, arises when a deficit amount is paid for income taxes, and the company expects to eliminate that deficit over the course of future operations. In this case, financial accounting income tax expense exceeds income tax payable. Income tax paid in a period is the actual amount paid for income tax. The income tax paid may be less than the income tax expense. Because the payment is in prior periods or refunds received in the current period, income tax paid reduces the income tax payable, which is carried on a balance sheet as a liability. The tax base of an asset or a liability is the amount at which the asset or liability is valued for tax purposes, whereas the carrying amount is the amount at which the asset or liability is valued according to accounting principles. Differences between the tax base and the carrying amount also results in differences between accounting profit and taxable income. These differences can carry through to future periods. For example, tax loss carry forward occurs when a company experiences a loss in the current period that may be used to reduce future taxable income. The company's tax expense on its income statement must not only reflect the taxes payable based on taxable income, but also the effects of these differences. Current tax assets and liabilities on companies' current tax liabilities is the amount payable in taxes and is the base for current taxable income. If the company expects to receive a refund for some portion previously paid in taxes, the amount recoverable is referred to as a current tax asset. Such differences between accounting profit and taxable income can occur in several ways, including revenues. Revenues and expenses may recognize in one period for accounting purposes, but different for tax purposes. Specific revenues and expenses may be either recognized for accounting purposes, not for net purposes, or not recognized for accounting purposes, but recognized for tax purposes. Subject to tax rules, tax losses in previous years might be used to reduce taxable income in later years, resulting in differences in accounting and taxable income. Adjustments of reported financial data from prior years might not be recognized equally for accounting and tax purposes, or might not be recognized from different periods. In different periods, deferred tax assets and liabilities. Deferred tax assets represent taxes that have been paid but have not yet been recognized on the income statement. Deferred tax liabilities occur when financial accounting income tax expense is greater than regulatory income tax expense. Deferred tax assets and liabilities usually arise when accounting standards and tax authorities recognize the timing of taxes due at different times. For example, when a company uses accelerated depreciation when reporting the tax authority to increase expense or lower tax payment in the earlier years, but use a straight line method for financial statements, although not similar in treatment on a year-to-year basis. E.g. depreciation of 5% on a straight line basis may be permitted for accounting purposes, whereas a 10% is allowed for tax purposes over the life of the asset. Both appreciates allows for total cost of the assets to be depreciated or amortized because these timing differences, cost of the assets can be depreciated or amortized. Under IFRS, deferred tax assets and liabilities are always classified as non-current. Under US GAAP, current and non-current base of this classification of the underlying asset or liability. Let me drink my water. Any deferred tax asset or liability is based on temporary differences that result in an excess or a deficit amount of paid for taxes, which the company expects to recover. At the end of each fiscal year, deferred tax assets and liabilities are recalculated by comparing the tax basis and carrying amount of the balance sheet item. Identified temporary differences should be assessed on whether the differences will result in future economic benefit. For example, Pinto Construction, a hypothetical company, depreciates equipment on a straight line basis of 10% per year. The tax authorities allow depreciation of 15% per year. At the end of the fiscal year, the carrying amount of the equipment for accounting purposes will be greater than the tax base of the equipment, thus resulting in temporary differences. A deferred tax item may only be created if it's not doubtful that the company will realize economic benefit in the future. In our example, the equipment is used in the core business of Pinto Construction. If the company is going to concern and stable is a going concern and stable, there should be no doubt that future economic benefit will result from equipment, and it would be appropriate to create the deferred tax item. Should it be doubtful that future economic benefits will be realized when the temporary difference will not lead to a creation of a deferred tax asset or liability. If a deferred tax asset or liability resulted in the past, but the criteria of economic benefit is not met on the current balance sheet date, then under IFRS, an existing deferred tax asset or liability related to the item will be reversed. Under US GAAP, evaluation allowance is established in assessing future economic benefit. Much is left to the depreciation of the auditors in assessing the temporary differences and issues of future economic benefit. Determining the tax base and asset of the liabilities. As mentioned in Section 2, temporary differences arise from the differences in tax base and carrying amount of asset and liabilities. The tax base of an asset or liability is the amount attributed to the asset or liability for tax purposes, whereas carrying amount is the base of accounting principles, such as differences in considered temporary if the expected that the tax will be recovered or payable at a future date. Determining the tax base of an asset. The tax base of an asset is the amount that will be deductible for the tax purposes in the future period as an economic benefit realized, and the company recovers the carrying amount of the asset. For example, our previously mentioned Reston Partners, example 1, depreciates equipment on a straight line basis at a rate of 10% per year. The tax authorities allow depreciation of approximately 15% per year. At the end of the fiscal year, the carrying amount of equipment for accounting purposes is greater than the assets tax, thus resulting in a temporary difference. Determining the tax base of a liability. The tax base of a liability is the carrying amount of the liability less any amounts that will be deductible for tax purposes in the future with respect to payments from customers received in advance of providing the goods and services. The tax base of such a liability is the carrying amount less amount of the revenue that will not be taxable in the future. Keep in mind that following fundamental principles in general, a company will recognize a deferred tax asset or liability when recovery statements of carrying amount will affect the future tax payment by either increasing or reducing the taxable profit. Remember that analysts is not only evaluating the differences between the carrying amount and the tax base, but also the relative or the differences in furniture profit and losses, and thus by implication of future taxes. IFRS offers specific guidelines with regards to revenue received in advance. IAS 12 states that the tax base is the carrying amount less any amount of revenue that will not be taxed at a future date. Under US GAAP, an analysis of the tax base will result in a similar outcome. The tax legislation within the jurisdiction will determine the amount recognized on the income statement and whether the liability will have a tax base greater than zero. This will depend on how tax legislation recognizes revenue received in advance. Changes in income tax rates. The measure of deferred tax assets and liabilities is based on current tax laws, but if there are subsequent changes in tax laws or new income tax rates, existing deferred tax assets and liabilities must be adjusted to the effects of these changes. The resulting effects of these changes are also included in determining accounting profit in the period of change. When income tax rates change, the deferred tax asset and liabilities are adjusted to the new tax rate. If income tax rates increase, deferred taxes will also increase. Likewise, if income tax rates decrease, deferred taxes will decrease. A decrease in tax rates decreases deferred tax liabilities, which reduces future tax payments to the taxing authorities. A decrease in tax rates will also decrease deferred tax assets, which reduces their value toward the offset of future tax payments to taxing authorities. To illustrate the effect of a change in tax rate, consider example 1 again, and that's the illustration. The timing differences that led to the recognition of the deferred tax liabilities for resident partners were attributable to differences in methods of depreciation and related effects on accounting carrying value and the asset tax base. The relevant information is restated below. The carrying amount of the tax base is equivalent is as such. And here's just the illustration. As may be seen from the discussion, changes in income tax rates have an effect on a company's deferred tax assets and liability carrying values, as well as an effect on the measurement of income tax expense in the year of change. The analyst must thus note that proposed changes in tax laws can have a quantifiable effect on these accounts if the proposed changes are subsequently enacted into law. Temporary and permanent differences between taxable and accounting profit. Temporary differences arises from a difference between the tax base and the carrying amount of assets and liabilities. The creation of a deferred tax asset or liability from a temporary difference is only possible if the difference reverses itself at some future date, and to such an extent that the balance sheet item is expected to create a future economic benefit for the company. IFRS and US GAAP both prescribes the balance sheet liability method for recognition of deferred tax. The balance sheet method focuses on the recognition of a deferred tax asset or liability should there be temporary differences between the carrying amount of and tax base of balance sheet items. Permanent differences are differences between tax and financial reporting of revenue and will not be reversed at some future date. Because they will not be reversed at a future date, these differences will not give rise to deferred tax items. These items typically include income or expense items not allowed by tax legislation and tax credits for some expenditure that directly reduces taxes. Because no deferred tax items is created for permanent differences, all permanent differences result in a difference between a company's effective tax rate and situatory tax rate. The effective tax rate is also influenced by different statutory taxes. Should entity conduct business in more than one tax jurisdiction. The formula for the reported effective tax rate is equal to reported tax rate equals the income tax rate divided by pre-tax income. The net changes in deferred tax during a reporting period is the difference between the balance of deferred tax assets or liabilities for the current period and the balance of the previous period. Taxable temporary differences. Temporary differences are further divided into two categories, namely taxable temporary differences and deductible temporary differences. Taxable temporary differences are temporary differences that result in a taxable amount in a future period when determining the taxable profit as the balance sheet item. Under US GAAP, a deferred tax asset or liability is not recognized or amortized. Goodwill, for amortized goodwill under IFRS, a deferred tax account is not recognized for goodwill arising in a business combination. Since goodwill is a residual, the recognition of deferred tax liabilities will increase the carrying amount of goodwill. Discounting deferred tax assets or liabilities is generally not allowed for temporary differences relating to business combinations as it is for temporary differences. IFRS provides an example of the initial recognition of an asset or liability in a transaction that is not a business combination affects either accounting profit nor taxable profit at the time of the transaction. US GAAP does not provide an exemption of these circumstances. As a simple example of a temporary differences with no with no recognition of deferred tax liability, assume that a fictitious company, corporate international, holding company of various leisure-related business and holiday resorts buys an interest in a hotel in the current fiscal year. The goodwill related to the transaction will be recognized on the financial statement, but the related tax liability will not, as it relates to the initial recognition of goodwill. Deductible temporary differences. Deductible temporary differences are temporary differences that result in a reduction or deduction of taxable income in the future periods when the balance sheet item is recovered or is settled. Deductible temporary differences result in a deferred tax asset when the tax base of an asset exceeds its carrying amount, and in the case of liability, when the carrying amount of the liability exceeds the tax base. The recognition of a deferred tax asset is not allowed to the extent that is reasonable expectations of future profit gains, which the asset or liability can be recovered or settled. To determine the probability of sufficient future profit for utilization, one must consider the following. Sufficient taxable temporary differences must exist that are related to some tax authority and some taxable entity, and two, the taxable temporary differences that are expected to reverse in the same periods are expected for the reversal of the deductible temporary differences. As with deferred tax liabilities, IFRS states that deferred tax assets should not be recognized in case that would arise from the initial recognition of an asset or liability in transactions that are not a business combination, and when at times of the transaction there is no impact on either accounting or taxable profits. Subsequent to initial recognition under IFRS and US GAAP, the deferred tax assets that arise from investments and subsidiaries, branches, associates, and interests in joint ventures are recognized as a deferred tax asset. IFRS and US GAAP allow the creation of a deferred tax asset in the case of tax losses and tax credit. The two unique situations will be further elaborated in Section 6. IAS 12 does not allow the creation of deferred tax assets arising from negative goodwill. Negative goodwill arises from the amount that the entity pays for the interest in a business is less than the net fair market value for the portion of assets, the liabilities, and the acquired company based on the interest of the entity. Examples of taxable and deductible temporary differences. Example 1 summarizes how differences between the tax base and the carrying amount of assets and liabilities give rise to deferred tax assets or deferred tax liabilities. Temporary differences in initial recognition of assets and liabilities. In some situations, the carrying amount of tax base of a balance sheet item may vary at initial recognition. For example, a company may deduct a government grant from the initial carrying amount of an asset or liability that appears on the balance sheet. For tax purposes, such grants may not be deducted when determining the tax base of balancing sheet items. In such circumstances, the carrying amount of the asset or liability will be lower than its tax base. Differences in the tax base of an asset or liability as the result of the circumstance described above may not be recognized as deferred tax asset or liabilities. For example, the government may not grant a small, medium, or micro enterprise SMME an attempt to assist these entrepreneurs in their endeavors to contribute to the greater GDP and create jobs. And job creation. Assume the particular grant is offered for infrastructure needs. In these circumstances, although the carrying amount will be lower than the tax base of the asset, the related deferred tax may not be recognized. As mentioned earlier, deferred tax assets and liabilities should not be recognized in case that would arise from the initial recognition of these assets or liabilities in transactions that are not a business combination of when and when at the time of the transaction there is no impact on either accounting or taxable profit. A deferred tax liability will also not be recognized at the initial recognition of goodwill, although goodwill may be treated differently across tax jurisdictions, which may lead to differences in the carrying amount and tax base of goodwill. IAS 12 does not allow the recognition of such a deferred tax liability. An impairment that an entity should, for accounting purposes, impose on goodwill will again result in the temporary difference between its carrying amount and tax base. Any impairment that an entity should, for accounting purposes, impose on goodwill and if part of the goodwill is related to the initial recognition, that the difference in tax base and carrying amount should not result in any deferred taxation, because the initial deferred tax liability was not recognized. Any future differences between the carrying amount and tax base as a result of amortization and the deductibility of portions of goodwill can constitute a temporary difference for which provisions should be made. Business combinations and deferred taxes. The fair value of assets and liabilities occurred in a business combination is determined on the acquisition date and may differ from the previous carrying amount. It is highly probable that the value of acquired intangible assets, including goodwill, will differ from the carrying amount. The temporary differences will affect deferred taxes as well as the amount of goodwill recognized as a result of the acquisition. Investment in subsidiaries, branches, and associates, and interest in joint ventures. Investment in subsidiaries, branches, and associates, and interests in joint ventures may lead to temporary differences on the consolidated versus the parent's financial statements. The related describes tax liabilities as a result of temporary differences will be recognized unless both the following criteria are satisfied. The parent is in a position to control the timing of the future reversal of the temporary differences, and it is probable that the temporary difference will not reverse in the future. With respect to deferred tax assets related to subsidiaries, branches, and associates are interest. Deferred tax assets will only be recognized if the following criteria are satisfied. The temporary differences will reverse in the future, and sufficient taxable profit exists against which the temporary differences can be used. Unused tax losses and tax credits. IAS 12 allows the recognition of unused tax losses and tax credit only to the extent that it is probable that in the future there would be taxable income against which the unusual tax loss and credit can be applied. Under U.S. GAAP, a deferred tax asset is recognized in full but is then reduced by a valuation allowance if it is more likely than not that some or all of its deferred tax assets will not be realized. The same requirement for creation of a deferred income. Should there be concerns about a company's future profitability, then the deferred tax asset might not be recognized until it is realized. When assessing the probability that sufficient taxable profit will be generated in the future, the following criteria can serve as a guide. If there is uncertainty as to the probability of future taxable profit, deferred tax asset as a result of unused tax losses or tax credit is only recognized to the event of the available taxable temporary differences. Assess the probability that the entity will in fact generate future taxable profits before the unused tax losses and or credits expire, pursuant to tax rules regarding the carrying forward and unused tax losses. Verify that the above is with the same tax authority and based on the same taxable entity. Determine whether the past tax losses was a result of specific circumstances or are they likely to be repeated, and discover if tax planning opportunities are available to the entity that will result in future profit. There may include changes in tax legislation that is phased in over more than one financial period to the benefit of the entity. It is important that the timing of taxable and deductible temporary differences also be considered before creating a deferred tax asset based on unused tax credits. Recognition and measurement of current and deferred taxes or deferred tax, current tax payable or received from tax authorities are based on the applicable tax rates at the balance sheet's date. Deferred taxes should be measured at the tax rate that is expected to apply when the asset is realized or the liability settled. With respect to the income tax for a current or prior period not yet paid, it is recognized as a tax liability until paid. Any amount paid is in excess of any tax obligation is recognized as an asset. The income tax paid in excess or owed to tax authorities is separate from deferred taxes on the company's balance sheet. When measuring deferred taxes in a jurisdiction, there are differences from different forms of taxation, such as income tax, capital gains tax, or secondary tax on companies. And possibly different tax bases for balance sheet items. In assessing which tax laws should apply, it is dependent on how the related assets or liabilities will be settled, and it would be prudent to use the tax rate and tax base that is consistent with how it is expected the tax base will be recovered or settled. Although deferred tax assets and liabilities are related to temporary differences expected to be recovered or settled at some future date, neither are discounted to present value in determining the amount to be booked. Both must be adjusted for changes in tax rates. Deferred taxes as well as income tax should always be recognized on the income statement of an entity unless it pertains to taxes or deferred taxes charged directly to equity, or a possible provision for deferred taxes relates to business combinations. The carrying amount of the deferred tax assets and liabilities should also be assessed. That the carrying amount may change even though there may have been no changes in temporary differences during the periods evaluated. This can result from change in tax rates, reassessments of the recoverability of deferred tax assets, or changes in the expectation of how an asset will be recovered when and what influences and deferred tax assets or liabilities. Here's an example. Presentation and disclosure. We will discuss the presentation and disclosure of income tax information by way of example, the consolidation and example of operations of income statement and consolidated balance sheet of Micron Technology are provided in Exhibit 2 and 3 respectively. Exhibit 4 provides the income tax note expenses for MU for 2014, 15, and 16. MU's income tax provision of fiscal year 2016 is $19 million. The income tax note disclosed in Exhibit 4 reconciles how the income tax provisions was determined, beginning with MU's reported loss before taxes. The notes the income tax provisions for 2016 that is current, which is then offset by the deferred tax benefit for foreign taxes for a net income tax provision of $19 million. Exhibit 4 further shows a reconciliation of how the income tax provisions was derived from the U.S. federal statutory rate. Many public companies with the required disclosure by displaying the information in percentage terms. In addition, the notes disclosure in Exhibit 4 provides detailed information about the derivation of the deferred tax asset of $657 million for 2016 and deferred tax liabilities of $2 million for 2016. These deferred tax assets are shown separately from MUs when the deferred tax liabilities are included in other non-current liabilities. Well, here's just the example of the financial sheet. The company has a valuation allowance against subsequently all of its U.S. net deferred tax assets. As of September 2016, the company had an aggregate U.S. net operating loss carrying forward $3.9 billion and unused U.S. tax credits carrying forward of $351 million. The company also unused state tax net operating loss carrying forward of $1.9 billion and the unused state tax credit of $211 million. The majority of the net operating loss carrying forward and a tax credit carrying forward will expire between 2021 and 2022 and 2036 respectively. Comparisons of IFRS and US GAAP, as mentioned earlier, through IFRS and US GAAP follow similar conventions on many tax issues. There are some notable differences, such as revaluation. Example 5 summarizes many of these key similarities and differences between IFRS and US GAAP. Though both framework requires the provision of deferred taxes, there are differences in the methodologies. Summary: income taxes. Okay, summary. Income taxes are a significant category of expense for profitable companies. Analyzing income tax expense is often difficult for analysts because there are many permanent and temporary timing differences between accounting that is used for income tax reporting and accounting that is used for financial reporting on companies' financial statements. The financial statement and note to the financial statement of a company provides important information that the analyst needs to assess financial performance and compare a company's financial performance with another company's key concepts of this reading are as follows. Differences between the recognition of revenue and the expenses for tax and accounting purposes may result in taxable income differing from accounting profit. This discrepancy is a result of different treatments of certain income and expenditure items. The tax base of an asset is the amounts that will be deductible for tax purposes as an expense of calculations and table income. It's the company expenses the tax base of its assets, and if the economic benefits will not be taxable if the tax base of the asset will be equal to the carrying amount of assets. The tax base of a liquidity is the carrying amount of the liability
less any amount that will be deductible for tax purposes in the future. With respect to revenues received in advance, the tax base of such a liability is the carrying amount less any amount of revenue that will not be transferred in the future. Taxable in the future. Temporary differences arise from regarding of differences in the tax base and carrying amount of assets and liabilities, the creation of a world deferred tax asset or liability as a result. Temporary differences will also allow differences reverse itself. Yeah, I read that already. Permanent differences result in a difference in tax and financial reporting of that will not be reversed at some future date because it will not be reversed at a future date. These differences do not constitute temporary differences and do not give rise to deferred tax assets or liabilities. Current tax payables or recoverables are based on the application tax rates on the balance sheet date and an equity. In contrast, deferred tax should be measured on the tax rate that the expected apply when the assets is realized or the liability settled. An unrecognized deferred tax asset and liability must be represented on the appropriate balance sheet date and measured against the probable future economic benefit. Deferred tax assets must be assessed for the prospective recoverability if it is probable that they will not be recovered at all or partly. The carrying amount should be reduced under US GAAP. This is done through the valuation allowance. Okay, so here I believe we have finished reading 29. We'll get into reading 30, which will be halfway done with the CFA program curriculum reading. So we will start reading 30 with financial reporting and analysis of non-current or long-term liabilities. I do hope my readings have been helpful, and I hope to see you guys next time. Goodbye.